Hello and welcome back to Module 5 of the Technical Analysis Masterclass, Identifying and Trading Range-Bound Markets. When a market has no clear direction, traders need to be able to pinpoint solid entry levels to work within the confines of the trading range. Section 5 of this course will focus on identifying quality range-bound markets and adapting the best chart patterns that work consistently well in this market environment. In this lesson, you will learn how to identify range-bound markets using channels and triangles. Key indicators to identify range-bound markets. Chart patterns to use at the top of the range-bound markets, and chart patterns to use at the bottom of range-bound markets. So let's take a look at how to correctly identify a range-bound market. A movement of a market can be categorized under three different labels: uptrending markets, downtrending markets, and range-bound markets. How long a trading instrument can stay in any of these categories depends on the time frame you're looking at, and also the particular instrument that you're analyzing. But generally, the markets spend more time in a range-bound market than they do in a trending environment. In many ways, trading in range-bound markets is easier than trading in the trend, because the take-profit zones are more defined and predictable. Range-bound markets can be found in most time frames, but as with any of the elements of trading, the bigger the time frame, the more significant the range. When locating quality range-bound markets to trade, it is important to trade the range that is large enough to provide traders with a meaningful expectation of the risk versus the reward for the trades that they're going to place inside that range. There are some key considerations when you're identifying a range-bound market, and depending on the time frame, the range can be constrained by support and resistance lines or by triangles. It is important to remember that triangle patterns are still reliant on support and resistance, but unlike a channel, support and resistance lines do not run parallel to each other. Now, the reason the time frame of a range is important relates to the opportunities that a trader can take advantage of when trading inside the range. If the time frame of the range is on the lower end, say 1 hour or a 15-minute chart, the opportunities are going to be restricted to entering long on the bottom of the range and entering short positions at the top of the range. However, if the range is trapped on a larger time frame like a 4-hour or a daily chart, there are more opportunities available to traders because the center of the range also becomes a trading zone, but we'll cover this more in the next section. Let's take a look at some of the key indicators that can help identify a range-bound market. Now, we've already learned about the indicators that are best to use when the market is in a range-bound mode, but there are also some indicators that you can use to help confirm that the market is not trending. Traditionally, moving averages are used to identify trending markets, but they are also useful to confirm when a market is range-bound. When the 20 and the 50 exponential moving averages start to flatline or crisscross like a ribbon on the time frame where the range is most prominent, it is generally considered a good confirmation of a trapped market. Now, when in doubt, a good rule of thumb is to count how many candles or bars in succession have not touched the 20 moving average on a time frame that the range being identified. A range-bound market will rarely print more than 15 periods without the price touching the 20 EMA. As the MACD indicator is derived from moving averages, it should not be a surprise that it can also be used to confirm a range-bound market. You need to be on the lookout for the histogram's range reducing as the range of price does. It is very important to note that the histogram reduces on the time frame that the range-bound market appears, and it may look like the MACD is displaying divergence. Now, this does not necessarily signal the divergence that we are looking for to place a trade, as this confirmation is just a consequence of the restriction of price movement. To use MACD divergence in a range-bound market, divergence needs to be present on the smaller time frames. Because Bollinger Bands are based on volatility, they are a great indicator to use when determining if a market is range-bound. There are two main things that will occur to Bollinger Bands in a range-bound market. Firstly, the bands will contract around the price and tighten around the highs and the lows like they do in the example on the screen. Secondly, price tends to fluctuate between the bottom band and the top band without much resistance at the middle band. Given what we already know about the 20 EMA and how it reacts in a flat market, it should not be a surprise that the middle Bollinger Band offers little support or resistance in a range-bound environment. The example that we can see on the screen highlights how freely price moves between the bands when the market is actually range-bound. Let's first take a look at range-bound market resistance. Now, as I mentioned earlier, smaller time frame ranges such as the 15-minute and 1-hour charts present trading opportunities at the bottom and at the tops of ranges. The pattern that is best suited to trading the top of a channel is a double top. Now, although double top patterns appear frequently in channels, it is important to remember that the resistance levels are a precarious zone for fakeouts, where price will look like it's about to break the resistance only to be hauled back into the zone. This is often a trap for many traders, and as such should be given extra consideration. Unlike double top patterns in other market scenarios, it is most important that you do not preempt a double top and wait for the confirmation of the break of the neckline. Another important component of trading double tops at channel resistance is to ensure that you have at least one form of Class B divergence agreeing with the pattern. As the market is directionless, the indicators that provide the most effective signals are the MACD, stochastic, and RSI indicators. MACD is the preferred indicator of the three in this situation because it confirms the converging of the 12 and the 26 EMAs, which helps bolster the evidence that price is losing momentum. Candle pattern confirmation is also a necessary requirement for the break of a neckline on a double top at channel resistance. The break of the neckline at channel resistance is one of the most difficult necklines to break, as the temptation for buyers to push the price back up to the resistance level is ever present. The candle patterns traders should be looking out for are shooting stars, dojis, bearish engulfing, bearish harami, or evening star patterns. It is very important to consider if the double top pattern has enough room inside the larger pattern to fill its expected take profit. If the take profit zone is past the bottom of the channel, you would not place this trade, as price would have to break the key support to reach its projected profit target. In some of the larger time frames, such as the 4-hour, daily, and weekly charts, there are opportunities to trade the top of a triangle pattern using the standard chart patterns. The three types of triangles, symmetrical, ascending, and descending, are all traded a little differently, so we will look at each of them individually. One of the best ways to trade the resistance of a symmetrical triangle is by identifying a head and shoulders chart pattern. Quite often, traders fail to locate a head and shoulders pattern in this environment because they simply aren't expecting one to be present. Once located, the price action of the head and shoulders pattern generally complements what the sellers are trying to achieve at the resistance point. Now, as you can see on the example on the screen, the head of the pattern is the first to test the overhead resistance, and by the time the right shoulder forms, a good pattern setup will often retest the top of the triangle. Now, with ascending triangles, the top of the ascending triangle can be best traded in the same fashion as the top of a channel, where a double top pattern helps predict the next movement of price. A double top pattern in this scenario is best traded with a conservative entry method. This is important because although a double top at a channel resistance could break at any time, an ascending triangle is a pattern that is generally regarded as bullish. That means that although the top of the triangle acts as resistance, the bottom of the triangle is being pressured up by a series of high lows, which puts added pressure to the top of the resistance line. As it was with trading patterns at the channel resistance, it is very important to consider if the chart patterns at the tops of triangles have enough room inside the pattern to fulfill their expected take profit target. If the take profit zone is past the bottom of the triangle, you would not place this trade, as price would have to break key support to reach its potential. Now let's take a look at range-bound market support. Once again, smaller time frame ranges such as the 15-minute and 1-hour charts provide trading opportunities at the bottom of the range-bound markets. The pattern that is best suited to trading at the bottom of the channel is a double bottom chart pattern. Double bottom patterns appear frequently in channels, and it is important to remember that just like channel resistance, support levels are also a precarious zone for fakeouts. Unlike double bottoms in other market scenarios, it is most important that you do not preempt a double bottom and wait for the confirmed break of the neckline. Another important component of trading double bottoms at channel support is to ensure that you have at least one form of Class B divergence agreeing with the pattern. As the market is directionless, the indicators that provide the most effective signals are the MACD, stochastic, and RSI. MACD is again the preferred indicator of the three in this situation because it confirms the converging of the 12 and the 26 EMAs, which helps bolster the evidence that price is losing momentum. Candle pattern confirmation is again a necessary requirement for a break of a neckline on a double bottom at a channel support. The break of a neckline at channel support is one of the most difficult necklines to break, as the temptation for sellers to push the price back down to the support level is ever present. The candle pattern traders should be looking out for are hammers, dojis, bullish engulfing, bullish harami, and morningstar patterns. It is very important to consider if the double bottom has enough room inside the pattern to fulfill its expected take profit target. If the take profit zone is past the top of the channel, you would not place this trade, as price would have to break key resistance to reach its projected take profit target. In some of the larger time frames such as 4-hour, daily, and weekly charts, there are opportunities to trade the bottom of the triangle pattern using a standard chart pattern. The three types of triangles, symmetrical, ascending, and descending, are all traded a little differently, so we will look at them again individually. One of the best ways to trade the support of a symmetrical triangle is by identifying an inverse head and shoulders chart pattern. Once located, the price action of the inverse head and shoulders generally complements what the buyers are trying to achieve at the support point. As you can see in the example on the screen, the head of the pattern is the first to test the support below, and by the time the right shoulder forms, a good pattern setup will often retest the bottom of the triangle. With descending triangles, the bottom of the descending triangle can be best traded in the same way that you trade the bottom of the channel, using a double bottom pattern, which helps predict the next price movement. The double bottom pattern in this scenario is best traded with the conservative entry method. This is important because although a double bottom at a channel support could break at any time, a descending triangle is generally regarded a bearish pattern. This means that although the bottom of the triangle acts as support, the support is being pressured down by a series of lower highs, adding extra pressure to the support line. As it was with trading patterns at channel resistance, it is very important to consider if the chart patterns at the bottom of the triangles have enough room inside the larger pattern to fulfill their respective take profit zone. If the take profit zone is past the top of the triangle, you would not place this trade, as price would have to break a key resistance to reach its potential. In this lesson, we have learned how to identify range-bound markets using channels and triangles, key indicators to identify range-bound markets, chart patterns to use at the top of range-bound markets, and finally, we learned the chart patterns to use at the bottom of range-bound markets. In the next section, we will take a look at range-bound markets on larger time frames and identify opportunities to trade in the middle of the range using specific chart patterns and signals.